Hi, I'm Tim Kelley from the Montgomery Fund, and welcome to this week's Video Insight. One of the things that has been missing from the Australian market in the last few years is merger and acquisition activity. Boards of directors tend to pursue M&A when they're feeling confident, and confidence has been in short supply since the GFC. But with the market running strongly this year and the IPO window well and truly open, it may not be long before that confidence returns and we start to see an increase in M&A activity. With that in mind, today I want to give you a few tips on some of the things that you should think about if companies you're invested in start announcing large acquisition transactions. Firstly, if you're on the receiving end of an offer, that's usually good news. Statistically, the target shareholders tend to be the ones who do well in any takeover. However, on average, takeover offers don't add value for the acquiring company's shareholders. The target shareholders receive a takeover premium and management gets to control a bigger business, but often it's the acquiring company's shareholders who miss out. Having said that, some acquisitions are very successful, whereas some turn out to be disasters, and so it's good to be able to tell them apart. The key is understanding value and whether the assets being acquired have a higher value in the hands of the company acquiring them. An example of this might be a telecommunications business that owns a network with spare capacity. If it acquires additional customers in an acquisition, it can extract more profit from those customers by adding the extra volume to its own network at no marginal cost. This sort of value creation is usually referred to as synergy value. And good acquisitions tend to be the ones that unlock synergy value and are ones where the bidder doesn't have to pay too much for the acquisition. Something to be wary of is acquisitions where the bidder does pay a large premium and you can't see how the assets are going to be worth more to the buyer than the seller. These sorts of acquisitions are often justified on the basis of EPS accretion, but even a bad acquisition can be EPS accretive, especially if it's a low growth asset funded with debt. As long as the cost of debt is lower than the earnings yield on the target, which is not that hard when debt is cheap, EPS accretion arises simply because of the increased gearing. You don't need an acquisition to increase gearing. You can do that easily with a share buyback. So don't be fooled by EPS accretion, focus on value, and if you can't see how the assets are going to be worth more than it's costing to buy them, it may be because they aren't. That's all for this week. We'll be back with more next week, and in the meantime, you can keep up to date with us on Facebook and Twitter.